on business planning, feasibility, forecasts, and financials. See, but first, just a little bit about us here at SCORE. We are a nationwide nonprofit that is an independent part of the Small Business Administration. What can SCORE do for you? We can provide free mentoring and educational services, such as this webinar. We can help you in all stages of your business, from that very first initial thought, great concept, all the way up through when it is time to sell. To find us, you can visit score.org/Minnesota, where you can request to find a mentor, such as myself and Neil, I believe, or find lots of other business-related information. And today would not be possible if it weren't for our sponsors and community partners that we have listed here. And now it is time to introduce today's presenter, Neil, who is a business professor and teaches MBA courses, and also a SCORE mentor. Welcome, Neil. I am going to stop.
I'd stop there. So a big part of what we want to try to cover on an overview basis is to think about what is the business going to cost when you start it, or perhaps on an ongoing basis as well. Then who will help us accomplish the plan? You can click the next view. And then how do we measure results? Every business plan has sections. You can put together a different list, but you can see the major components of a business plan. And again, this can be for a new business or a continuing business. And the financial statements are a very large portion of the activity here, which we're going to move to. Next slide. We're going to talk about a manufacturing business just as an example to try to get through some of the accounting and financial concepts. And it's going to be a very simple business, and it's just going to manufacture cell phone cases, leather cell phone cases. Next slide. And this is a grid that we've put together, which identifies some of the key things in terms of justifying a new investment or new business or an ongoing business. And the things we're going to talk about today are whether or not you achieve success, if the business should continue or not continue, and then if there are things that you can do to reevaluate your position, particularly from a financial standpoint, to see if there's some other benefits you can place into the business to increase its value. Next slide. You can click on that, please. Yeah. Yeah, you might as well click the whole page.
Okay. Hopefully I won't go too far. If I do, I'll try to back up.
That's good.
That's
That's
okay.
good. So what we need to understand are the cash requirements to basically invest in a new business or perhaps invest in the expansion of your current business. How much money is that going to cost? What are the categories of expenditures? You may not know specifically what the individual line item costs are, but you have an idea of the major components. And then every business or change in a business, even if it ultimately becomes very, very successful, there's a period of time where the business has to sort of catch up to its full running rate, so to speak. And while that's happening, that business, even again, ultimately it might be very successful, is going to still burn cash. So it's important to understand, what do I need day one? And then what sort of cash requirements will I have going through the initial periods when the business isn't self-perpetuating just yet. Forecasting, critically important. pardon me, we'll try to build a little bit on that in terms of whether you're doing some projection for your own operating benefit, whether you're doing a projection because you're looking for some additional outside help. That may be hiring employees, quite honestly, or it certainly could be if you need to go to a bank and look to get additional financing. And whatever the cash requirement is, it's that decision point before you walk to the bank. And that is whether or not this is something that you can fund or that your business can fund without putting it at risk in terms of having enough operating cash to continue the business. When we talk about forecasting and cost expenses, uh, the main point I think I want to make is that a break-even analysis is, I believe it's very, very important. We talk about 5-year financial projections and calculating balance sheet, calculating cash flow. But when you're in the early stages of a decision, I think it's really important to understand what the break even is, and we'll take a look at that. For projection purposes, it's always good to have 5 years in any financial forecast or statement, 2 years back, the current year, and 2 years forward. And then as you analyze that, you should be able to determine, is this something that you want to continue to pursue? Then go ahead and finish the plan. Next slide, please. Okay, this is a quick rundown of my little iPhone case business. These are the components that we're going to need to put it together. The plan is we're going to sell it through Etsy, and it's a low volume, initially a part-time business. Next slide. So to start off any sort of accounting or financial analysis, I think a very good place to go is let's just price or cost out one item in the business, in our business or in our business expansion. And that is, let's take a typical product or an average of the products or typical service, if it's a service business, and let's try to put together, what sort of costs we're going to incur to start this business or to expand the business. And those things are either inventory or assets. Now, for this particular business, you can see there's a list of the items on the left side, whether they're inventory or an asset. The workbench and the shelving are assets. They basically last more than 1 year. Inventory is not. Inventory is something that will only last for a short period of time, and that's inventory is often referred to as current assets, and the workbench and the shelving are often referred to as fixed assets. And you can see the total at the door before we even start anything is about $1,400. Next slide. So now let's try to price and cost one of these items just to see whether or not it's a feasible process or thought it's a feasible product to try to make and sell. So we have, we'll call it a bill of materials. You can call it a operating menu or operating guide. In any event, what are the components that we need? How much? What's the cost? Stitching, decals, labor. Labor, I use $30 an hour. This is an hour. And, we could discuss what that is or how that's derived. But I'm just assigning, for purposes of illustration, what a labor cost would be. And I'm using 30. Shipping. So we end up with a total cost of about $70. Now, in this kind of business, and we can all come to a different conclusion on this, but using a cost markup is not a bad way to develop some pricing. So if I use a 50% factor, I would get to a selling price of about $105, which that seems like it's not too far off in the terms of market value. Etsy, it's a flat fee for this purpose, 6.5%. So my net revenue is about $99, which gives me a margin, which is the difference between my revenue of $99 and my cost of 70. That is my margin. That's the profit and very close to the cash that results from that transaction. And I'm also assuming here that the business will have a fixed cost of $1,000 a month. Next slide, please. Thank you. This is a depiction of the my break-even analysis. So you'll see the bar that's running across the bottom there is the fixed cost. So that's cost that any business or any project will incur regardless of activity. So that might be rent, it might be utilities, it could be insurance. There are a number of things that go in there, but those are expenses that don't vary by very, very much when we take into account wherever the volume of activity is in the business. The line that's kind of in the middle of the chart is total cost, and that would be my fixed cost plus whatever the variable cost is to make the item or to provide the service, if we're talking about a service business. So now you can see that that line goes up as we go forward. And each of the items on the bottom, 2 represents 20, 4 represents 40. That's just the to explain the bottom of that chart. Would you click one time, please? So you can see the break-even point is somewhere between 30 and 40 units. It's not exact. And that takes my total cost and compares it to my revenue, which is the uppermost line, the yellow line. So that's as we sell more units, our revenue is going to increase. And where the revenue crosses the total cost line, that's referred to as break even. And that basically says, in order for me to break even on a cash flow basis, I would have to sell, say, 35 of these items. Is that something that I can do in a month, or is it something that's going to take me longer? Am I comfortable that I'll get that kind of volume? And the last thing, one more click, please. That's where the initial investment is recovered. So if we see, and you have to go pretty far out there in terms of units, I think it may be actually close to over 80. Click again, please. And that was our beginning cash flow, the $1,370. And that represents selling 84 units just for their margin dollars, which is, basically the same number. So the last point there is that in order for us to recover our initial investment, we would have to produce and sell at a minimum about 84. And again, is that something we're prepared to do? Is that within the vantage of our expectancy for how long this business is going to exist and how much effort you have to put into it? Okay, next slide. Thank you. All right, so every business transaction results in a position in the financial records or the accounting records. We're not going to go through every category of accounts. We'll talk about groupings a little bit, but just to give you a flavor for this, if we have 4 transactions around my cell phone case business. So initially, I contributed $3,000 to get the thing going. As you know, the startups were $1,370. And let's say at this particular point, I've made and sold 20 cases. So I have sales, but my net margin is a loss because I didn't generate enough profit to cover my fixed costs. And then the last transaction is I went out and bought more inventory, $2,500. And we can see the net effect of this on our balance sheet. You can see the cash position, inventory, our fixed assets, which are the assets that were for the workbench, the investments, sorry, that were for the workbench and for the shelving a little bit earlier. And we see now we have equity of $2,600. And we might say, well, wait a minute, I put in $3,000. I should have $3,000, right? No, because you lost $432 along the way. And a net loss is, in effect, a reduction of equity. And the logic is it's reduced the value of the business. So that, that makes sense. Next slide. Okay. We will talk about the three main financial statements and try to encapsulate some other items here. The first is a balance sheet. It presents the position of the entity at any date. It's now more referred to as a statement of financial position, and it includes three groupings of accounts, uh, which are categories of transactions, within your books or your bookkeeping. Assets, a truck, inventory, receivables, a patent, trademark, and then liabilities, what I owe my vendors, what I owe my bank, what I owe the person that holds my mortgage, what I owe for the purchase of the truck, and the balance is equity, and equity is whatever contribution I put into the business, like the $3,000 in the previous slide, um, plus or minus additional investment that I might make, maybe outside investment that I may bring in if I decide to take on a partner, and also the net value of the profit and loss of the business goes into the equity section as well. And the concept of the balance sheet is assets minus liabilities always equal equity. Next slide. Here's a pretty simple example of a balance sheet, the statement of financial position. Go down the left side, current assets. We have inventory. I think we all understand what that is. And it's a current asset because anything that we have in inventory, we expect we will consume over the next 12 months. Next one, trade receivables. If our business is not a completely cash business, then we're likely to have receivables. I ship something to my customer and they will pay me in 30 days. Very, very common. So I sell $15,000 in sales to a customer and I don't get cash that day. I get the receivable of $15,000 that day that in the future will be converted into cash. Cash, again, that's fairly straightforward. Long-term assets. Now, this is, pardon me. It's very dry here in New Jersey. I apologize. Um, Long-term assets are property, plant, and equipment, which would be the building that you own for your business or the production line or the racking, tooling, those kinds of things. That all land value. That's a fixed asset or long-term asset. And see the total of that's 170,000. Now we go to the right side and we can see when we sell to somebody, we may accept a receivable rather than the cash. And on the other side of that transaction, when we buy from somebody, we may owe that business rather than paying them immediately in cash. So that's what trade and other payables are. Current portion of long-term borrowing, if you have a loan, a bank loan, whatever you have to pay over the next 12 months is the current portion of that debt. And then whatever you have to pay over the balance of the loan is the long-term portion of that debt. So we see we have an entry in the short-term current portion, and then an entry in the long-term borrowings, and that's the only long-term. So we have total liabilities. Equity is the capital that we put into the business, our initial investment, additional investment, and offset by retained earnings, which is the accumulation of the profits and loss in the business. Total equity of 80,000, liabilities and equity, and total assets equal. So we have the balance sheet. Next slide. Next statement is the income statement or the profit and loss statement. This one I think people are more familiar with, and that's really two groupings. One is income, which would be all your revenue from sales, whether you're selling products or services. It could be service income, could be investment income. And then the second category is all costs and expenses. Um, in my way of defining this, costs are things that are attributable and variable with activity. So those are costs to produce an item or costs to sell a service. Expenses tend to be more associated with the ongoing business. That might be rent. It could be truck depreciation. It could be certain parts of insurance. It could be salaries. They tend not to vary with the volume of activity in the business. And if income less costs and expenses is positive, that's a profit. If it's negative, that's a loss. Next slide. And here's a simple example of an income statement. So we have revenue, we have cost of sales, which reduces from revenue. Cost of sales is inventory, utilities, salaries, labor, um, some plant and equipment costs. Um, and then the gross profit is the difference between the revenue and cost of sales. And then we have additional expenses in the business. We have to get those products to our customers, distribution costs. We have administrative costs. Perhaps we're paying ourselves a salary, or we have some accounting assistance. Other expenses, that's all other categories. Finance charges, if we're borrowing money, we would have interest costs. Now that's a very, very small percentage or a small portion of the total amount of account categories you may have. And you could take these categories and break them down further, depending upon how detailed the information level you would like. And if you're doing analysis or reporting to a bank. Profit before tax, 43,000. Income tax, net income after tax, 30. Okay, next slide. The last statement is the cash flow statement, and we'll look at sort of a very basic chart here that feeds into cash flow or cash balance. The first is operating activities, and that's basically the income statement that we just looked at. So that would be a summary of my operating activity for the year, and the net income after tax would be cash positive, and that would come from operating activity. Working capital would be the change in positions of my current assets, current liabilities. Accounts receivable would go in there. Inventory would go there. Trade payables would go there. And as those balances change, they're plus or minus in terms of cash flow. The last box on the right is investing in financing. So investing is, business is doing well. We decide to buy another business, or we decide to invest in another asset for production purposes. That's going to be a consumer of cash. And financing would be you get the bank loan or you bring in a partner and there's an influx of cash to the business offset by the liability, of course, but still it increases cash flow. So those are the main categories of cash flow activity in the business. Next slide. This is the most complicated one, and I think maybe I'm just going to focus on the four yellow markings there, which goes back to the flow chart that we just looked at. So we have net cash from operating activities, net cash from changes in working capital, from investing activities, and financing activities. We can see the net of all of this is an increase or decrease in cash. What was our cash at the beginning of the year? And what's our cash at the end of the year? Pretty dramatic increase. But we did some financing there to generate some significant cash inflow. Next slide. So how do we determine, whether or not we've been successful? Well, it's got to be financially stable enough so that it is sustainable. If it can't continue, obviously you've got a problem. And a good thing to do there is track your expenses and revenue and make sure that you're keeping an eye on those so you can make a profit. You may say that you're successful, pardon me, if you hit a certain level of sales or a certain number of customers, and that may be linked to your operating objectives or your projections for new business, where you thought you would be after a year, after 2 years, after 3 months. Customers are always a good indicator. So if there's a way for you to get information back from your customer, it's not a straight dollars and cents issue, but it certainly is the kind of thing that might get you repeat sales or recommendations. Okay, next slide.
Did I skip over one by mistake?
I don't think so. I think we're good.
Okay.
Yeah. So the cell phone business case, was it successful? Did we set some objectives and goals? I think we said initially we were going to make some money. It was going to be part-time. So it probably is successful. We didn't need a tremendous amount of units over a month. So that would be the key thing. Did I get to that number of units that gets me to a break even or not? And sometimes, businesses don't always make money. You have good years and bad years, good periods and bad years. But of course, if you consistently run losses, then you're going to have a problem. Try to see if you can compare yourself to whatever your competition is. Industries have lots of information about this, both in terms of general business conditions, but also more specifically, which I think is more pertinent to our discussion today. They have a lot of financial information. If you're in a business that has many businesses that are public companies, even though they may be significantly larger, SEC, Securities and Exchange Commission reports, which have an incredible amount of financial information that can be very interesting if you want to expand your business or maybe even want to start a business. You got to work it. It's not easy. Running your own business or expanding your product line, your geographic area isn't an easy thing to do. Most times the butter falls down when the bread slides off the table. But again, you got to keep working it. Try to make sure you understand what your cash requirements are. Cash is always king. Next slide. Just as a bit of a side note here, but these are a couple of terms that tend to be end up being very much financial, but they're kind of business overall business oriented. Um, Feasibility analysis. I mean, we can say that our break-even analysis is a key part of that. It's also good to understand, what are you competent at, or what is your business competent at? Um, do you have a specific valuable idea or technology? Is it rare? Is it, are you the only game in town? Or does it cost so much money to invest that you're going to keep competition out? Concept test, always try to get a survey, maybe even hand out a good or provide a service to see if you get customer feedback. This is also important when you're trying to determine pricing levels, both the competitive information, what your costs are, and also what your initial preliminary target customers, how they react to that price. And it's always good to stop and think, and not a bad idea either to give it up if it's not financially viable, or consider what you can do to revise it to try to make it financially viable. Next slide. Success and failure. You can click that again. It's there we go. Good planning, bad planning. It's not the only reason. Um, Not controlling spending is pretty important, and sales focus is, of course, pretty important. Next slide. Okay, I am done with the presentation. I again apologize for whatever my responsibility was in the initial mess up in getting the slides on the screen. But I guess if we have any questions.
Let's see, there we go, questions. If anybody does have any questions, if you could type those into the Q&A, then Neil will get those answered for us. Just want to let everybody know that they will receive a copy of today's slides and the video presentation in your email. So just let you know, even though I was a little delayed on getting the slides corresponding with Neil, but we got it to happen after a few minutes there. And again, just if you have any questions at all, go ahead and type those into the Q&A. See, and also to let you know, see if I can flip through that. You will receive a survey, so you can let us know what we can do to improve or other topics that you may be interested in. Let's see. And if we don't have any questions, I'd like to thank everybody for coming today. And thank you, Neil, so much
Welcome.
for presenting.
All right. Take
We don't
care.
have anything in there. Everybody have a great afternoon.